So thanks for joining with us today. We've got Jake over here and Justin with VanDyk Mortgage. We wanted to kind of bring an aspect a little differently today with what we're seeing in the market. So we wanted to talk a little bit about bridge loans, some simultaneous closings, and kind of how the inner workings work with it. And then also some strategies that we're seeing out there with fellow real estate agents. So I think if anything, you'll at least get 1 or 2 points today out of it. You know, as long as you pull away with something, it's always something to learn. So let's dive into it. So we're going to talk about bridge loans. We'll talk about simultaneous closings. We'll talk about other ways to utilize equity. So if they own a current home, what are other ways that we can utilize that equity for the new place? I wanted to talk a little bit about appraised value versus sales price value and the willingness to pay the difference. And then some other real estate agents and their strategies of what I've seen and what I think you might get something out of there. So bridge loans, you don't, until we've been into this market, you really haven't seen it. Not too many lenders do them because it's a pretty big risk. If you think about it, you're bridging the equity of this property over here to try to put a down payment to buy this property over here. And what if, not saying we're going to see this, but what if we saw 2008 again and everything stopped tomorrow, right? It's a very big risk that now this lender has this bridged equity line over to the new property. And what if you couldn't sell this home? The whole idea is that they're able to sell this home very quickly. Now, I don't think that's going to happen. We have limited inventory. We're just seeing the housing market just crush it out there. But it's still limited on who's going to offer this.
And you can see there are numerous things that could go wrong with it and why it's risky, not just a financial collapse.
Yeah. So as we go through it, think about if you're the bank or the lender trying to do this loan, think about would it be risky in your eyes, and you'll kind of get it. And that's why I'll go over this, but I want to talk about other strategies that I think cost less and are easier to work with in our area. So I think you'll get it and we'll compare. So bridge loans, the whole idea is to leverage their current house that they own as much as possible so they can pull that equity out and put it into the new place as a new down payment. Or possibly if they have a pretty decent home, maybe it even gives them the ability to pay cash, right? Cash is going to be definitely king with these 20 and 30 times multiple offers on properties. It eliminates the contingency contingent upon sale of another house clause. Obviously we have sellers that are not willing to look at properties or offers with that in it. The total loan on the current home cannot have, when you're doing the bridge loan, you can't exceed 80% of the current market value. So if it's worth $1 million, you can't exceed 800,000 in a loan. However, most lenders are actually going to be more conservative than that. You'll see some lenders, if they're offering it, it might be 75% of current value. Some are 65%, some are 50%. So even if they offer it, the most you'll see is 80%, but you'll actually probably see it a little bit less than that. Interest rates on this are typically 4 to 8%. So this is a short-term loan. Again, the idea is that they're going to sell this current home in a very quick pace, maybe a month or two after they purchase the new one. So interest rates are 4 to 8%. It's only typically allowed on their primary residence. So let's say they own multiple properties and they're trying to do something this on an investment property. That's not going to happen. It's only if they currently own it as their primary residence. You will typically see, and this is one of the big points, you will typically see that that lender doing the bridge loan is going to charge 1 to 3% in just origination fees. Forget what other closing costs are involved. They're going to charge between 1 and 3%, and it's typically the 2 to 3% range. So on a $500,000 loan, they're paying $10,000 to $15,000 just to tap into this equity very quickly. So it's not the cheapest idea out there. typically must pay off the bridge loan within 12 months. Again, it's all about short term. So the idea is that maybe they'll sell it in a couple of months after they buy the new one. Some lenders require that the current home be free and clear just to even do this. So I talked about other lenders may be limited on how much they'll loan for this bridge loan, but some lenders might require that that current home be free and clear for them to even try to do this. It's interest only payments if there are payments, and that the closing costs are typically going to be more expensive. I already mentioned that there's going to be a couple of points in origination fees, but then you also have closing costs because a bridge loan is still a type of mortgage. So you're still going to have to pay recording fees and intangible tax on the mortgage and different things like that, to where you're still going to go through a lot of closing costs. Most lenders do not offer this program because of it being risky. Unfortunately, VanDyk Mortgage does not do them. I wanted to explain the differences of it because I want to share a lot of other things that I'm doing that I feel personally are financially better than this opportunity here and easier. But you do see some people ask about this and what does it take, what's entailed with it, things like that. So those are kind of the basics that you'll see. What I wanted to give you an example of is, let's say they have a current home worth about $700,000. Let's assume the lender will allow you to go up to 80% loan to value. So that would be a total amount of $560,000. Let's say after fees and closing costs, that equates to about $25,000. And then they currently owe $225,000. So 560 minus your closing cost minus the amount you currently owe gives them approximately $310,000 for a new down payment on the new place. Sales price on the new house is, let's say, $800,000. They put all the money down, get a new mortgage of $490,000. They must qualify for the new home mortgage payment and any mortgage payments, taxes, or insurance for the existing home as well. So this is not meant for everybody. So you have to have enough income with the borrower to qualify for both typically. The reason why is, let's say our example of 2008 comes and all of a sudden they can't sell this house quickly. We want to make sure that they have the ability to pay for both. Any questions so far? Okay. Oh, we got a question. I'll pause, Nikolai, for your question. Looks like there is high closing costs. There is. So think about it. The lender doing the bridge loan knows that this loan is going to get paid off in the next couple of months, right? Let's assume within the next 6 months. Why not a HELOC instead? I'm going to go over that in a minute. So just to go back, the lender knows that this bridge loan is going to get paid off in the next couple of months. A lender always makes money from the interest that is being paid. Therefore, that's why they're charging the 1 to 3% upfront to kind of make up for the interest basically that they're not going to pay. So that's why it's so that's why it's high in cost. And you just kind of led into my next idea is, why not a home equity line of credit? So home equity line of credit, some local lenders will actually go to 90% of the current market value. So this actually gives you 10% more than the bridge loan. What is the benefit of a bridge loan versus HELOC? We're going to get to that, Norma. So all good stuff. So it'll actually give you 10% more than a bridge loan, at least 10% more. Closing costs on a home equity line of credit are actually very minimal. Right now, most banks will actually pay all the closing costs to get the line for the client to get the line of credit. when you go to pay off and close a home equity line of credit, the closing costs are still only between 1 and 3,000, right? So a bridge loan, let's say it's 15 or 20,000 to close, whereas a home equity line of credit is maybe only 1 to 3,000 even if you closed it. There's no prepayment penalty outside of just paying the closing costs back, and that it's interest only. So it minimizes what you're actually going to pay while you have this loan. An interest rate on a home equity line of credit is typically prime, which prime rate is 3.25%, plus a margin. The margin on average is between 0.75 and 1.5%. So somewhere between 4, let's say 4.75, 5% is going to be their rate. Again, who cares? Because we know we're going to pay this off very quickly. The whole idea is it's a cheaper way to get equity out of a home. You can get more to help you utilize more towards the new place. And it's interest only, therefore you're minimizing what you're having to pay. So Norma, kind of going into your question, bridge loans, you're going to pay a lot. You're going to be limited on what you're going to get. You're going to pay a lot in closing costs, and you're going to have to pay it off fairly quickly. Home equity line of credit, you can potentially get more. It's cheaper. It's interest only. The rates are not bad right now. Therefore, all the clients we're talking to, we're trying to explain that the home equity line of credit is the better way to go.
And as far as the rate goes, there's a lot of the banks are setting a floor, and they're currently at the floor. So
yeah,
to keep that.
That's a great point, Jake. So a floor means the lowest rate that the client will get charged. So let's say it's 3.25 plus 1%. So the rate is 4.25. Well, their floor might be 4%, meaning they have to charge at least 4%. So that's still not bad.
No.
4% versus 5, 6, 7%. So you're actually still saving money going a home equity line of credit route. So great opportunity, great rate of leverage. And I always tell clients, get the home equity line of credit set up now. You don't have to make a payment until you actually draw from the line of credit. So you can set it up today. Let's say Jake goes out and gets a home equity line of credit today, but he doesn't find the place for 6 months, right? Maybe it just takes time to get the right house because of multiple offers. Well, he's not paying anything on this home equity line of credit until we're ready to actually get into contract and move forward with pulling the money out.
And you can utilize only a portion of it. You can utilize all of it. And you don't have to utilize, basically I'm saying you don't have to utilize all of what's available to you.
Right. It gives you options.
Many more options.
Yeah, a lot more opportunity. So let's see what we got. Does the HELOC have to be requested before listing the home? Shova, great question. And I do recommend that they try to do that, because the goal would be to tell the lender that the home equity line of credit is for their primary residence. Some lenders do have a stickler that if it's listed first, they may not want to do the home equity line of credit. So that's why when we're doing our buyer consults or getting pre-approved with Jake and I, we're talking about this as soon as possible, getting it done as soon as possible. That way, when you go to list, it's already done and ready to go and no questions asked. Does VanDyk do HELOCs? We can help the client do them, but there's a couple of opportunities with local banks and relationships that I have where that's where you can get that 90% combined loan to value. So unfortunately, it may not be the best to go through VanDyk, but I definitely have a couple of great referral sources for you guys. One is Hancock Bank, and I do have a certain person, but you're welcome to inquire yourself. Another is Synovus Bank. There's a few banks out there, and I try to keep tabs on all of them on who has the best home equity lines of credit. Synovus and Hancock Bank are the top two.
Pretty good.
Yeah, they're really good, really quick, have a great relationship with them, all that kind of stuff. Does HELOC affect debt to income ratio if not used? So great question. And the answer is no. Until you pull from that equity line, you don't have a monthly payment. Therefore, it doesn't go into their debt to income ratio. However, we're probably utilizing this so that they can buy the new place. We estimate and figure out what their new payment will be in the assumption they pull from it. So that way we're making sure that it's included in their debt to income ratio when they go to qualify. Again, it's interest only. A lot of times they're amortized over 15 or 20 years. So the payment is as minimal as possible and still makes it work. Yep, but great question. Any other questions on this? This is really good stuff, guys. All right, we'll move on unless we see something. Sorry, I'm getting the chat off here. Okay, so other ways, how do I get rid of this one?
Oh. Drag it.
Oh, there we go. Okay, so sorry, tech, not the most techy here. Okay, so other ways to utilize equity. A lot of people forget that you can actually use 401k and retirement to purchase a house. And some retirements and 401ks allow you to pull money from their plan with no penalty as long as you pay it back within the first 60 or 90 days. So what you can do is actually pull from the retirement, utilize it to get the new place. Maybe they can't tap into their current home. You know, there could be different reasons why we have to do this. But the whole idea is that once they sell their current home, they pay this 401k and retirement back right away. So it's another cheap way to get down payment and another way so that way they can tap into something knowing that it's going to get paid right back. The biggest thing I need to tell you is they need to check with their financial advisor before doing this. Not all plans allow this. There's so many out there. Some allow it, some don't. But I always remind people, hey, you might want to check because it might be another way to tap into some quick money, especially with the market doing so well. These plans are at the top. So it has some equity built into it as well.
And I mean, you don't want to advise somebody to pull out of something and then automatically incur a tax penalty. So it's important to check with the financial advisor for sure.
100%. Yep. But I have seen clients do it. So I just want to share that it could be another way, an opportunity to tap into something and utilize your equity to pay this back for some reason that you couldn't do a bridge loan, for whatever reason you couldn't do a home equity line of credit, you know, whatever the case is. Okay. Other ways to utilize equity. So we always forget, you know, you guys as agents are always asking questions, right? And so do we on the mortgage side. So I'm always trying to find other ways that we can utilize what we have to work with. So I have a client right now, actually, Jake and I were just talking about this. The borrower is qualified up to about 300,000 and she does not want to make it contingent upon the sale of her current house, because if she did that, then she would have no chance right now. So her dad is chipping in and said, hey, I have a lot of retirement. I have a lot of liquid funds. I'm going to give her the 50% down as a gift, and we'll document it as a gift. And then once her home sells, she can just pay me back and I'll pay back wherever I take it from. And so now we're able to show a pre-approval letter up to, we did it this morning up to 360 because that's the range she wants. But now we're going to show 40 to 50% down because dad's willing to do that to help give us the most leverage on trying to win the deal. And then she's just going to pay dad back when she sells her house because she has a ton of equity in it. So, and the reason why we're not diving into, you're like, maybe Justin, why aren't you doing a bridge loan or home equity line of credit? I'm trying to minimize what kind of payments this borrower has because we are limited on income. However, the dad also said, hey, if giving a gift won't get her there, I'm willing to co-sign. So that's another thing to think about is you should be always asking, hey, maybe family needs to help co-sign to get us where we need you to, so we don't make it contingent upon the sale of a house. And then it's the goal is to get the house. We'll deal with refinancing later, paying dad back later after we sell your other house, right? It's all about finding ways to make it work. And her price point, 320, she had 20 offers and she was number 3 in line, so she still didn't get the last house she was in.
Not that
so
far off, but yeah.
And I'm sure you guys have all, stories for you guys to
And
tell.
regarding gifts, I mean, documentation is always something that needs to be talked about for gifts. Basically talk to us before moving any money. Less is more as far as documentation goes. So if we can go with just getting a letter, that's obviously the way we want to go. So talk to us before moving any money and having your buyers move any money too.
And the last thing to know about gifts, people perceive that an IRS gift is the same as what we call a gift in the mortgage world, and it's not. So the IRS says if a family member were to give somebody a quote unquote gift, it's only limited to it's $15,000 per person per year per the IRS. First, we in the mortgage world do not report anything to the IRS, and we just call it a gift because there's no other way to call it in the mortgage world other than a gift because it's not their own money. So I've had people give $100,000, $200,000, $300,000 as gifts, but it has no partake in an IRS and what the IRS calls a gift. So there's something else to know. Okay. So simultaneous closings, rather than, hey, trying to leverage your current house and selling that later, some people may not have any of the options we talked about, and sometimes it might be contingent upon the sale of a house. So this is when a borrower must sell their existing home to purchase the new one. Maybe for some reason they can't get the equity out. Maybe they don't have enough income to qualify for both mortgages. Again, maybe they don't have family to help them. We run through all these things, but sometimes they just don't have these opportunities. So the whole goal is to set up the closing on the existing home the same day as the new one. Now, first, I will say that I do know of some banks out there that do not allow you to close both properties on the same day. So if they're not using a company like VanDyk Mortgage that allows this, one of the questions you need to ask is, hey, will you allow both homes to close on the same day? If they don't, then A, you might have a big problem, or B, maybe you might have to explain to the client, maybe we need to go talk to Jake and Justin and find a different opportunity and work with a lender that does allow it. Closing the existing home in the morning, and we're working on closing the new one in the afternoon. Some of Shoba and a few of you, I'm sure you guys have done this in the past. Gives enough time for the title company to wire the funds from the existing sale to the new title company in the afternoon for the new purchase. The whole idea would be, for example, you as the listing agent can control that piece of it with the new buyer on the sale of their current house. So maybe you set up a 60-day close on the existing house, since you can control that, which would give up to approximately 30 days or so for the new home to be found by the buyer, and then another 30-ish days to close on the new one, and then you're closing on the same day for both properties.
It's super common. When we are posed with these questions, I don't know if everyone is aware of how common this is. It's very common. And with you being on the sell side and the buy side, you're controlling a timeline as far as your sale goes. So you can, just good examples of what you can do to make this work as is. So. Yeah.
So the question I pose at the bottom is, disclose that a new purchase is contingent upon the sale of a current home. So in our world, we don't have to disclose it. So typically on a mortgage pre-approval letter, you're not going to see it. On the contract, technically you don't have to disclose it. So I posed the question because some of you might have, there's different opinions on what is right and what is wrong. As the buyer agent, you're probably not wanting to disclose it because you're trying to help out the buyer get the deal. As a listing agent, you're going to be mad of like, why didn't you disclose this to me? So the reason I posed the question, I'm not here to give you the right or wrong answer because it's really up to you. But I'll give you a quick example.
Broker.
What and the broker, of course. So, but I'll go over an example. I had a deal. It was contingent upon the sale of another house. Nothing was on the pre-approval letter. Nothing was on the contract. The sale of the current house was in Virginia, and so it got pushed back it got pushed back like a week due to the buyer's funds and pulling it from this, that, and the other, and it was causing a delay. So the listing agent called me and was very upset, and she's like, I can't believe you didn't tell me about this. And I said, well, what do you mean? She goes, you should have told me. And I said, well, unfortunately, I don't have to. And so the first question I asked her was, why didn't you call me to ask the question? So what I'm going to is, if you're the listing agent, you should always follow up and ask, is this contingent upon the sale of another house? Just because you don't see it doesn't mean that it may not happen or exist. And so she, in this conversation, she was very upset at first. And I said, well, why didn't you call me and ask me? Because at that point, I would have to tell you yes, because that is how we qualified them. And she goes, well, why would I call you? And I said, well, you would call me to ask me this question, and then you wouldn't be upset. She didn't care that it was contingent upon another house. She just felt that it wasn't disclosed to her and it was getting caught at the last minute. And I said, well, I always try to give value to my agents to say that I'm happy to call if they're uncomfortable with the questions, or you should call and just go through a couple of questions, let alone asking, how are they qualified? Do you have documents and all the other things that you should ask? Hey, you should also ask, is it contingent upon the sale of a current house? So again, I'm just sharing an example information for you to know on both sides. If you're the listing side and the buyer's agent side, different approaches, different things to think about.
And I mean, from our perspective, we're reaching out to listing agents on any offers that our buyers are putting in, just to, put in a good word and be like, hey, we're, pre-approved, like ease their minds and hopefully, win the deal. Mm-hmm. So we're preemptively doing this. However, it also would help if you knew the questions to ask and to get all that handled too. So,
yeah, good point. So most banks, again, won't tell you that, or a lot of banks, most large banks, I should say, will say that they cannot close the transactions on the same day. So even if you can't get the client away from a big, large, bank, maybe you call and find out what's going on, ask those questions. So I'm all about controlling the situation. Well, actually, let me take a step back. So important things: make sure your borrower gets all their documents to us on time for pre-approval, obviously. You might need a tight inspection period to win the deal, probably not explaining anything you don't already know. And we usually offer to give a loan commitment in 2-ish weeks. Again, it could be quicker. I say ish to let everybody know it's done. So if we are about to win the deal with a simultaneous closing, I try to do some of these things to help win it and make the seller feel as comfortable as possible. So again, put your listing agent hat on, what could we do that would make the seller feel comfortable? Well, giving a loan commitment in a week and a half or 2 weeks would probably make them feel more comfortable, tight inspections and so forth. But going back to control, I always like to control the situation as much as possible.
You don't say.
But yeah, you don't say. So let's say you're working with your client but the new buyer on their existing house is not your client, right? So they're working with a Joe Schmo lender, and now their deal is the domino effect I talked about, to where now it's going to affect our transaction. So if you don't know that mortgage company, and again, now you're on the listing side, right? Because that buyer's coming to you for that deal. I always try to say, hey, if you can get us involved and maybe we can win the deal and actually do that transaction, now we have full control of that one to make our original deal, your seller, which is now buying a new place that we're working with, also use VanDyk Mortgage. So not saying it's going to work every time, but now you've put the control now in that buyer's lenders in their pocket, and who knows how that control is going to happen. And now I can do everything possible to make this work, but if they don't close, then we don't close. So if we can control that and know that that's going to happen under Justin and Jake's wing, and we already know it's already going to happen on the new deal, it's the best way to control the situation. So if there's any time that we can ever get involved with something like that, let us know. We try to match fees. We try to work through exactly what the other lender was doing so that there's not any change in their financial situation. But the change that does happen is VanDyk is controlling both deals.
Real questions.
Got questions. Do you have a Spanish-speaking agent in your office? And even though may not be the specific top of the seminar, before the end, can you please give me a list of all loan types of VanDyk mortgage offers, estimated period of time? Yes, we'll go over a couple of VanDyk things at the end. What if their home deal falls through? So Shobo, we would try to pick, if we weren't doing it, I would say sometimes there's things that VanDyk Mortgage can do that others can't. And maybe there's a unique way I can find a way to make it work. So maybe we don't get the control up front, but maybe if it falls through, maybe we can come in and be Superman. The other thing that we used to promote, and just because of the market, it kind of has fallen to the side, is VanDyk Mortgage will pre-approve any offers coming in on your listing. So let's say you have the listing, that new buyer comes in and they're going to use, ABC Bank. And you're like, great, I don't want to work with them, but the buyer's adamant that they work with them. But in the offer, you say, hey, all offers need to get pre-approved by Jake and Justin with VanDyk Mortgage. Well, we pre-approve them, and all of a sudden ABC Bank falls through. Maybe they just don't know what they're doing. I don't know, whatever. But if we pre-approve them, we found a way to make it work. So maybe since we already have the info, it's one step ahead to where we can jump in and be Superman on the deal. If it does truly fall through and there's no way to make it work, then we would either have to hit them with both payments. Maybe again, we get a cosigner involved on our borrowers to help add income to the pot. Maybe they go and rent their place and find a quick person to lease. I didn't put this in the slide, but it's actually a good thought that we can use projected rent, or not projected rent. We can use a current lease of a vacating primary residence to help offset that payment. So maybe for the first year, they just rent it out and then sell it. Those could all be ideas. I can get very creative and I will exhaust any and all options until I say a deal is going to die. But you might have that 1% chance it truly does die. So unfortunately that there may not be control over that.
And in regards to Spanish speaking, we do have some Spanish speaking loan officers. I'd be happy to reach out to you and give you their information too. And regarding what loans we do, FHA, VA, USDA, conventional. We have some non-QM options, purchase, refi. I mean,
we pretty much, we bond loans. We pretty much have it all, except for we don't do lot loans. We don't do HELOCs, home equity lines of credit. But again, we got great referral sources for that. And bridge loans. I'm like, what other thing? So we do anything from the basics. We have renovation loans. We have down payment assistance. We have all those sorts of types of things. And we can get very creative on different things. And what's nice about VanDyk Mortgage is Fannie and Freddie Mac those are the guidelines. And VanDyk Mortgage holds very strong that all we do is follow those guidelines for qualifications, where other lenders may have tighter requirements that are stricter than the actual guidelines.
Overlays.
And what they call overlays, right? So I think we've answered everything. So we'll keep moving. If I can, what happened here? There we go. So appraised value versus sales price. This is huge right now, right? We're dealing with this everywhere. So obviously limited inventory and multiple offers are pushing values at the highest. Borrower is allowed to pay, people don't realize this, but the borrower is allowed to pay the difference of appraised value versus sales price on any loan as long as the buyer is willing to. So sometimes due to their large planned down payment, let's say somebody's putting $100,000, $200,000 down, paying the difference is actually not altering the payment. And I'm going to give you an example of that in a second. And then the other switch is sometimes we can restructure it to where, let's say they were starting out with 20% down, and let's say there was a very large appraisal gap. Maybe we structure it with 5% down and use the other 15% to make up the difference. And I'm going to give you an example of that with numbers. I think it's easier to see. So let's say this is a situation of not altering the payment. So let's say a sales price of $400,000, their down payment is $250, mortgage is $150, and their payment, just an example, let's say is $1,750 a month. New situation. All of a sudden it appraises for $25,000 less. I think that's favorable in this market right now. So sales price is still 400. Seller's not willing to come down. So their down payment is still going to be 225 plus the 25,000 to make up the difference. Their mortgage payment still is 1,750 because of how much they're putting down. Literally nothing is changing. But paying an extra 25,000 to get the house they want means more for most people right now. So, boom, it doesn't change anything. So move forward. Another question. We're gonna just wonder if not disclose sale contingency will be unethical. Great question, Shoba, real quick. And that's where I give the question marks. I honestly have had agents write up offers as cash because the client can prove that they can quote unquote pay cash. And then they have me come in and do the mortgage as long as I can close on the closing date. And it has thrown some agents for a loop because that wasn't disclosed. But the agent did that knowing that the client was willing to pay cash, but in the back end, as long as they closed on the closing date with the mortgage, the seller didn't care because they got their money. And I'm going to talk about that, but not disclosing current things or making it look like one thing versus another. I agree with you. That's borderline. And I know reputations mean a lot out there. I'm going to go over some other things that I've seen real estate agents do. I'm not saying you guys should do them all, but I just want you to see things because this is a lot about buyers right now, right? But Shoba, just like you do a lot of listings. So these are a lot of things to keep in mind when you're getting offers on your listings because you want to follow up with a lot of these things. What to ask, are you sure you're not going to try to get a mortgage? So we'll talk about that and kind of come back to that question, Shoba, but that's a very good one. All right, so I think we kind of understand this situation. Nothing changes, kind of makes sense. I've
also seen it written in where, they will, if it appraises short by X amount, the seller will come down, to this price, but then they're still responsible for it. So there's a lot of written in stuff that we're seeing that we weren't necessarily seeing 6 months ago that's happening now. So you'll also be seeing some of that stuff. Yep.
Yeah, we're going to go over all that. So, so coming back real quick, just to work through the full restructure. So different situations. So now we have a borrower, same sales price, 400,000. Let's say this borrower is doing 20% down. Mortgage amount is 320, and let's say their current payment is 2,200, and there's no mortgage insurance because they're putting 20% down. Let's say in this situation, which I think we can all agree is happening a lot, it appraises for $50,000 less. So it appraises for 350, sales price is still 400. The value to make up is 50,000. So what we'll do is we'll change it to where we're going to do a down payment of 30,000, which is actually only 8% of 350 plus the 50,000 to make up the difference of what it didn't appraise for. So still $80,000 out of pocket. But now, since they're only doing 8% down, technically speaking, they're going to have mortgage insurance. So let's say, just for giggles, that mortgage insurance is $150 a month. Well, now their payment went from $2,200 to $2,350 a month, and the change is from loan amount going up and some mortgage insurance. Okay, well, is it worth it to lose the home over $150 a month? Probably not in this market, right? So these are other ways that we're strategizing with borrowers to still utilize the same amount of money. It actually does not change their payment too drastically, and it still is a win-win for the situation. I've even had listing agents call me and say, I see they're putting 20% down, but what if it doesn't appraise? How could you work through this? And I only went through this because I already knew that the buyer literally waived all contingencies, inspections, mortgage, appraisal. They had to do it to get this house. So I knew the buyers were all in, or they lost their deposit. So I said, well, they're all in no matter what. They want this house. So here's how we would restructure it. And I basically went through an example like this. And he said, great. So you're telling me one way or another, we can work through a possible low appraisal, because he was expecting it to be somewhat low, but not drastic. I said, absolutely. And I already know that the buyers are all in for it. He said, okay, great. And it got us the deal. So I was actually really impressed that the listing agent called me to ask all these questions. I already had permission from the agent and the buyers to kind of go over this, but it helped win the deal. And they weren't the most amount of money down, but they were giving the most in sales price, which was netting the most to the seller. And it won the deal. So, hey, if it wins the deal, it wins the deal. All right. So Jake kind of just alluded to this, but here's some recent strategies I've been seeing. I'm not saying to do all of them, I'm just telling you what I'm seeing out there and what people are doing. So the one Jake just mentioned is we have started to see on contracts bracketing of different spots of where it appraises and what the buyer and seller were willing to do. So an example of, assuming a $300,000 sales price, if it appraised between 275 and 300, the buyer was still willing to make the sales price 300, right? They're willing to make up that difference of 25,000. If it appraised between 260 and just under 275, the new sales price would be 290, right? So they're still willing to make up that gap. And if appraisal comes in between 260 or below, sales price will be 280. So it was what I loved about this, it was very, very clear on both sides to where this deal was going to close no matter what. I mean, the buyer was all in to certain degrees. The seller was agreeing to all this. And it was very black and white of whatever it appraises for in these brackets, buyers already agreed in writing they're willing to do it. And we know this deal was getting to closing.
They already have preemptive solutions to any sort of appraisal issue,
yeah,
which is nice.
There's no question that this was going to get done. There's no gray area or, oh man, we're going to try to renegotiate.
And everybody knows what to expect.
Yeah,
if something were to happen.
Great expectations. So you could spin this I've seen it done a few different ways. Some agents have written long paragraphs on page 10 of different things, but it was all in writing. So it was very clear on both sides what to expect and who's willing to pay for what. The other one I already mentioned, again, I'm not saying to do this, but I have a few agents where they have basically said the only way to win this is to show up front a cash offer. So they wrote up as the deal as a cash offer. These clients did have enough assets in the bank to technically pay cash, but they didn't want to for the fact that they were going to pull some from retirement and they were going to have to pay a lot of taxes on it. So we executed a mortgage and we said, hey, give us X amount of time. As long as we can close a mortgage on that day, let's close as the mortgage. But the buyers knew, hey, if you can't close by that date for whatever reason, then I'll be willing to pay cash. So we did it. We closed on time. I have one agent. Again, they didn't call me or ask me, but I guess they didn't know that there was a mortgage being done. So I guess I can understand that. But we closed on time. I explained what we were trying to do to the listing agent. She knew me, so she felt very comfortable with what we were trying to do and knew that, they were well qualified with Justin. And boom, it got to the closing deal, and therefore it helped the buyer not have to pay cash. And I actually have that same agent doing it on another deal right now, where we're going to execute the mortgage in a certain amount of time. So,
or pay the cash and do a cash out refi. We can also do that.
Yeah. So the other idea is if they pay cash, we can do what they call delayed financing, to where they can refinance later. However,
they have to use their own money.
They have to use their own money, all of it, in order to do it. And when you do it as a purchase, you get a little bit lower of an interest rate versus you doing it as a cash out refinance. So there's pluses and minuses on both sides. All right. This is kind of smaller, but I saw option 1 we just talked about with the bracketing, and I saw this all joined together. In our area, and a lot of us had never thought about this, but in our area, the contract says, and we're customary to check that the seller picks the title company. And if the seller does it, the seller pays the owner's title policy. Well, you could actually have the buyer pick their own title company. And with that clause, it says that the buyer will pay their own owner's title policy, which could save the seller another, let's say, $1,000 to $3,000, depending on the price. Now, you might say, well, Justin, I like to pick my own title company to control the situation, like you like to control it. And I get that. So maybe you put in writing that the seller picks the title company, but the buyer pays the owner's title policy. Few different ways to do that, but it's all about how much more you can net to the seller. And I thought this was another great idea to, who's going to pass up on an extra couple $1,000s to the seller? So really, really cool idea that we heard recently. What if the loan is not approved for some reason or appraisal issue and it can't work? They can't get cash. If they don't, so maybe Shoba, what might be a good example here is, let's say somebody's putting very minimal down, 3.5% down. They don't have anywhere to get money. They can't get gifts. They're on their own. They can't get co-signers. Unfortunately, that just might be a deal that might fall through. I think that might be what you were alluding to. If we're coming across this, we're literally asking the client, do you have a family member to get cash? Can you pull from any retirement or 401k? In some cases, you can get as creative as a family member getting a loan, and then that family member giving that money as a gift to the borrower. So let's say mom or dad doesn't have the actual money, but they're willing to go to the bank to get a loan for, let's say, $10,000. They can go to the bank, get a loan for $10,000 in mom or dad's name, and then they would put it in their bank, and then we would document it, and you would want to get with me first, so we document it the right way. But then they would give that as a gift to the borrower as a gift, and we wouldn't know it's a loan. So Jake's laughing because it's being pretty crazy and creative, but I will exhaust all options. But again, Shoba, there might just be that one borrower or two that we just can't find a way to make it work.
If it's minimum down and it appraises low, you waive the appraised contingency, and they do not have the money to do it. I mean, I believe the financing contingency would come into play at that point, but that's a broker question.
Yeah. So, some of these things, Shoba, you raised the question, unethical. I mean, if you're the buyer's agent, you're doing whatever you can for the borrower to get the deal. If you're the listing agent,
if they can't close, and then they said it was a if you're talking about a specific example of whether it was a cash deal and then they tried to finance it and then they can't get the cash, if that's what we're talking about, then yes, they would lose their escrow.
Is that what we're talking about, Shoba? I know you're chatting. I don't know if you can actually talk on this.
I don't think so.
So if they're putting 50,000,
call us.
Yeah, call us, Shoba, and maybe we could talk more. A lot of creative different ways to make it work. Like I said, if we'll do everything we can, it depends on if they're waiving different contingencies or not. It depends on how much they have to work with. It depends on all the other options. And some of these things we're talking about very upfront at pre-approval, right? So if we're going into this, we should have already had a lot of conversations to know what our plan of attack is, so that we don't get to the point where are they going to lose their deposit? Because that's obviously not the goal. So if we're trying to do so all my examples, I've talked to the agent and the borrowers ahead of the offer. So we went in with a game plan of attack to where we didn't exceed that risk, that threshold of the buyers. So it's a lot of communication, and it's a lot of working with, your lenders and your agents that and trust and have those conversations to figure these things out. And that's what we're here for. So that's all I had for you. It seems like we got some good conversation going. So I hope you guys got a few things out of it. Do you guys have any other questions about any of it?
We're also going to type our information in the text box. So if you have any questions or need anything, and Norma, give us a call and we can hook you up with a Spanish-speaking loan officer that we have. But if you have any questions or anything or concerns, you can give us a call and we can definitely run through it. Looks like we got some of that.
Yep. Thank you. I missed the beginning. Can we get a copy of the PowerPoint? Yeah, we can definitely send that out, Julie. So we'll make sure that it gets out to you guys. Thank you.
Awesome.
Oh, new one. Thank you. Good stuff. All right, good show, but thanks all. Thank you guys.
Okay, we're going to type in our information there. Give us a call, email, text, whatever works. And we'd be happy to help you. But until then, have a good day. We look forward to seeing you in the office. Have a good one.